All right, class, welcome. You know, in managerial accounting, we spend a lot of time on these high-level strategic decisions, right? We talk about capital budgeting, variance analysis, all those big performance metrics. But here's the thing, all of that high-level analysis, it completely falls apart if the basic fundamental transactions aren't recorded correctly. So today, we're going to do a deep dive into one of the most fundamental of all, how a business actually accounts for paying back a long-term loan. It might seem simple, but trust me, a misunderstanding of this process, which we call amortization, can cause huge problems that ripple all the way through your financial statements. Understanding this isn't just about bookkeeping, it's about knowing the true cost of borrowing money, managing your relationship with lenders, and really protecting the financial health of the entire company. So let's jump in.
So let's start with a really practical question. Your company writes a check for $500 to pay its loan. Now, a very common mistake students make is to think, okay, simple. Cash goes down by $500 and the loan liability goes down by $500. But that's just not right. It completely ignores a huge piece of the puzzle, the cost of borrowing that money in the first place. So the real question for any accountant or any manager is this. Of that $500 payment, how much of it is actually paying down the debt on your balance sheet and how much of it is getting recorded as an interest expense on your income statement for that period? Because if you get that split wrong, you're not just messing up your numbers, you're distorting your company's profitability and making it look more or less in debt than it truly is.
To get that allocation right, we first have to break down the payment itself. I mean, think about one of the core principles we always talk about, the matching principle. You have to recognize the costs you incur in the same period you generate revenue. Well, using someone else's money to run your business, that capital, it has a cost. And that means every single payment you make on a loan is actually doing two different jobs at the exact same time. And here are those two parts. On the left, you've got the principal. This is the big one. It's the actual amount you borrowed, the liability sitting on your balance sheet. When you make a principal payment, you're actually reducing that long-term debt. Now, on the right, you have interest. And this is crucial. Interest is not a reduction of your debt. It's an expense. It's the fee you pay the lender for the privilege of using their money for that month or that year. It shows up on the income statement, and of course, it lowers your net income. Every single payment you make is split between these two. And here's the key idea for today. That split isn't 50-50, and it's not static. It changes with every single payment. As we're about to see, you pay the most interest right at the beginning of the loan, and that amount goes down over time.
So this constantly changing split, well, that's the big challenge for us as accountants. If the portion going to principal and the portion going to interest changes every single time, how on earth do we keep our financial statements accurate month after month, year after year? You can't just guess. You can't just estimate it. For your balance sheet to be correct, you have to report the exact outstanding debt. And for your income statement to be right, you have to record the exact amount of interest expense. To do that, you need a precise, systematic tool.
And thankfully, that tool exists. This system that brings order to the chaos, that gives us a crystal clear guide for this whole process. It has a specific name in both finance and accounting. You can think of it as the official roadmap that tells you exactly how to make your accounting entries for the entire life of the loan. And the formal term we use is an amortization schedule. The word amortization sounds complicated, but it just means spreading a cost out over a period of time. And that's exactly what the schedule does. It's literally just a table, but it's a very powerful one. It gives you the precise breakdown for every single payment you'll ever make on that loan, showing you down to the penny how much to debit interest expense and how much to debit notes payable. It takes all the guesswork out of it and ensures your books are perfectly aligned with accounting principles.
And I really want to stress this. This isn't some obscure academic concept. It's standard practice. Any business that knows what it's doing, whether it's a tiny startup or a giant corporation, uses amortization schedules. It's the universal method for accounting for these kinds of loans. So whether your career takes you into corporate finance, or you become an auditor, or you end up working at a bank, knowing how to build and, just as importantly, how to read one of these schedules is an absolutely foundational, non-negotiable skill.
Okay, enough with the theory. The best way to really understand this is to get our hands dirty and actually build one from scratch. When you see how the numbers move and interact, that's when it all clicks. So let's do that now. We'll keep the scenario nice and simple. Let's say our company gets a $10,000 loan. The bank is charging a 10% annual interest rate, and the deal is we'll make one single payment at the end of each year for 4 years. These are our starting variables, and from these 3 pieces of information, we can figure out the entire life of the loan. Now, the calculation for each year follows a very logical 3-step process. And the order here is absolutely critical. You can't mix these up. Step 1, you always calculate the interest expense for the period first. Why? Because interest is the cost of using the money that you had for that whole period.
So we take the loan balance at the start of the period and multiply it by the interest rate. Simple enough. Step 2, once you know how much interest you owe, you can figure out how much principal you paid. You just subtract that interest amount from your total fixed payment. Whatever is left over is what's actually chipping away at your debt. And finally, step 3, you calculate your new loan balance. You take the balance from the start of the period, subtract the principal portion you just calculated, and that gives you your ending balance, which of course becomes the beginning balance for the next period. You just rinse and repeat this 3-step cycle for every payment.
Okay, let's do this for year 1. Take a look. We start with the full $10,000 balance. Step 1. Calculate the interest. 10% of $10,000 is $1,000. That's our interest expense for the first year. Step 2. Figure out the principal. We take our total payment, which is $3,154.71, and we subtract that $1,000 in interest. That leaves $2,154.71. That's our principal reduction. So for step 3, we subtract that principal from the original $10,000, and our new ending balance is $7,845.29. Now think about the journal entry for a second. You'd credit cash for the full payment, debit interest expense for $1,000, and debit notes payable for just under $2,200. See that? A huge chunk of that very first payment didn't even touch the debt. It was pure expense.
And here it is, the whole thing, start to finish. This table tells the entire story of the loan. Now just let your eyes scan down the interest column. See that clear downward trend? It goes from $1,000 in year 1 to just $287 in the final year. Why? Because you're calculating that 10% on a smaller and smaller balance each year. Now look at the principal column. It's doing the exact opposite. As less of your fixed payment is needed for interest, more and more of it gets to go toward paying down the actual debt. That's the magic of amortization right there. By the final year, almost your entire payment is building equity, not just covering an expense. And the most important number on this whole table? That's 0 at the very end. The liability is gone.
So we can build the table. Great. But you should always be asking yourselves, okay, so what? Why does this actually matter in the real world of business? And the answer is that this little table is fundamental to pretty much everything: financial integrity, smart planning, and clear communication with everyone who has a stake in the company.
The implications are huge. First up, the integrity of your financial reports. Without this schedule, the notes payable liability on your balance sheet is wrong, and your interest expense on the income statement is wrong. You're misrepresenting both your debt level and your profitability. Second, budgeting and forecasting. This schedule lets you predict your interest expense and principal payments to the penny, which is absolutely essential for managing your cash flow. Third, strategic decisions. It gives you the hard data you need to analyze things like refinancing. If interest rates drop, you can use this schedule to figure out if taking out a new, cheaper loan makes financial sense. And finally, compliance. I guarantee you external auditors will demand this schedule to verify your numbers, and your bank will use it to make sure you're sticking to the terms of your loan agreement.
At the end of the day, the real power of the amortization schedule is that it transforms ambiguity into certainty. It gives you a clear, predictable, transparent path to getting a liability off your books. It's a structured plan that guarantees with 100% mathematical certainty that when you make that final payment, it will perfectly wipe out the last bit of principal and interest owed. In a business world full of uncertainty, this turns a complicated long-term problem into a simple, manageable process. And that is a huge part of managing financial risk.
So I want to leave you with one final thought, a question to chew on before our next class. This whole analysis was based on making the fixed required payment. But what if your company has a great quarter and decides to pay more than the required amount? What if they throw an extra $1,000 at the loan? How would that extra payment, which goes 100% toward principal, change all the numbers that come after it? How would it affect the interest calculations and the total life of the loan? If you can answer that, you're moving from just being an accountant to thinking like a strategic financial manager.